The average American eats fast food at least once a week. Multiplied that by hundreds of millions of people, and you start to see a machine so large it barely resembles a restaurant industry anymore. It resembles a nation-sized economy, hidden inside paper bags and drive-through windows. But here's the strange part. Most of the people running these restaurants don't actually own the brand. On the sign above their heads, they paid for the right to use it. They paid for the right to follow someone else's rules, buy someone else's ingredients, and hand over a slice of every single sale, forever. And somehow, thousands of people every year are still lining up to do exactly that. So why would anyone pay millions of dollars for the privilege of not truly owning their own business? To understand that, you have to understand the strange, brutal, and surprisingly brilliant economics of building a fast food franchise empire. Let's start with the number that scares most people away before they even begin. Opening a single fast food location isn't cheap. A single McDonald's franchise can cost anywhere between $1 million and $2.3 million to open, depending on the location, size, and whether you're building from the ground up or converting an existing building. That number includes the initial franchise fee, which alone can run around $45,000 just for the right to use the brand. Then come the real costs: real estate, equipment, kitchen build-out, signage, initial inventory, staff training, marketing launch costs. And here's the part most people don't expect. The franchisor doesn't just take a cut once. They take one continuously, for as long as the restaurant exists. Most major fast food brands charge an ongoing royalty fee, typically between 4 and 5% of gross sales, not profit, sales. That means even in a slow month, even when margins are thin, that check still has to be written. On top of that, franchisees usually pay another 4% or so into a shared marketing fund, whether they personally believe in that ad campaign or not. So before a franchise owner earns a single dollar for themselves, close to 10% of every transaction is already spoken for. Now you might be wondering, if the deck is stacked this heavily in favor of the parent company, why would anyone want in? The answer lies in something most industries can't offer: a tested, repeatable system. When someone buys a fast food franchise, they aren't just buying a restaurant, they're buying decades of trial and error, already solved for them. The menu is proven. The supply chain is already negotiated at massive scale. The marketing is handled by a team with a budget larger than most Fortune 500 companies spend on advertising. Essentially, franchisees are buying a shortcut past the hardest, riskiest years of building a business from scratch. And that shortcut is worth something. Independent restaurants fail at a staggering rate. Some studies suggest that more than half close within the first few years. Franchise fast food locations, by contrast, have a dramatically higher survival rate, often cited above 90% in their early years. That statistic alone is why banks are far more willing to lend money to someone opening a Subway or a Wendy's than to someone opening an unbranded diner with a dream and a business plan. There's also a financing advantage most outsiders never consider. Major franchise brands often have pre-negotiated relationships with lenders, sometimes called preferred lender programs, which streamline the loan approval process for new franchisees. A first-time restaurant owner walking into a bank alone might face months of scrutiny and a high chance of rejection. A franchisee backed by a recognized brand name, with financial projections based on thousands of existing locations, walks in with a completely different level of credibility. But surviving isn't the same as thriving, and this is where the real story of the franchise empire begins to get complicated. Revenue in this business comes from a strange, layered structure. At the very bottom, individual location owners make their money from food sales, drink sales, and increasingly, delivery and mobile order fees. But layered above every single one of those sales sits the corporation, quietly collecting royalties, marketing fees, and often, rent. Yes, rent. In many major franchise systems, especially McDonald's, the parent company owns the real estate the restaurant sits on. Franchisees don't just pay to use the brand. Many of them pay rent to the very company they're franchised under. Sometimes rent tied not to a flat fee, but to a percentage of sales. This turns the franchisor into something closer to a landlord empire wearing a fast food costume. It's a brilliant structure, because it means the parent company profits, whether or not any individual location performs well. Franchise fees keep flowing, royalties keep flowing, rent keeps flowing. The franchisee absorbs almost all of the operational risk, while the corporation collects a steady, diversified stream of income across thousands of locations simultaneously. This is why some analysts have described major fast food corporations less as restaurant companies and more as real estate and licensing companies that happen to sell burgers. In fact, in some years, McDonald's has generated a larger share of its operating income from rent and licensing than from actual food sales at company-operated restaurants. The burgers, in a strange sense, exist mainly to justify the real estate. Now let's talk about the hidden costs, because this is where many hopeful franchise owners get blindsided. Labor costs have surged dramatically over the past several years. In some states, minimum wage increases for fast food workers specifically have pushed hourly rates above $20 for a business built on thin margins and high volume. A few dollars per hour per employee can be the difference between a profitable location and a location bleeding cash every month. Then there's food cost volatility. Beef prices spike, cooking oil prices spike, packaging costs rise with inflation. Franchise agreements often require owners to purchase supplies from approved vendors, sometimes at prices higher than the open market, because consistency across thousands of locations matters more to the brand than any individual owner's profit margin. Equipment breakdowns aren't optional expenses either. A single broken fryer or ice cream machine, and yes, that infamous ice cream machine problem, is a real, well-documented issue in the McDonald's system, can mean thousands of dollars in repair costs and lost sales in a single week. Some franchisees have reported waiting weeks for authorized technicians because the equipment is proprietary and can simply be repaired by any local repair shop. And here's something most outsiders ever consider. Franchise agreements often require costly remodels every 7 to 10 years, mandated by the corporation, not optional, not negotiable. Franchisees have been legally required to spend hundreds of thousands of dollars updating a restaurant that was already working perfectly fine, simply because the brand wanted a fresher look. There's also the cost of technology upgrades. As fast food chains push harder into mobile ordering, self-service kiosks, and delivery at integration, franchisees are often required to purchase and maintain new digital systems, kitchen display screens, and point-of-sale software, sometimes on the corporation's timeline, not their own. What looks like innovation from the customer's side often looks like an unplanned expense from the franchisee's side. Insurance is another quiet drain. Commercial property insurance, liability insurance, and workers' compensation costs have all risen sharply in recent years, and franchise agreements typically require owners to carry coverage well above what a small independent restaurant might choose on its own. So who actually makes real money in this system? It's rarely the person who owns just one location. The real profits in fast food franchising tend to belong to multi-unit operators, people or companies who own not one restaurant, but dozens, sometimes hundreds. Owning multiple locations allows for shared management, shared purchasing power, and the ability to absorb a bad month that one restaurant with a strong month that another. Some of the wealthiest franchise operators in America aren't the founders of the brands at all. They're individuals who quietly built portfolios of 50, 80, even over 100 locations across multiple states, turning fast food ownership into something closer to a real estate empire than a restaurant career. These operators often run their portfolios like private equity firms, buying underperforming locations at a discount, fixing operational inefficiencies, and scaling profits location by location. There's also a psychological layer to why this business model works so well, both for the corporation and the customer. Fast food brands aren't really selling food, they're selling predictability. A Big Mac in Tokyo tastes nearly identical to a Big Mac in Texas. That consistency creates trust, and trust creates repeat customers, which creates the massive, reliable transaction volume that makes the entire royalty-based system profitable. In the first place, for franchise owners, there's a different psychological pull. Many are drawn not by a love of burgers or fried chicken, but by the appeal of owning something with their name attached, of being their own boss, even if that boss still has to follow strict rules written by a corporation thousands of miles away. There's also a sense of joining a community. Franchise conventions, regional owner meetings, and shared operator forums create a support network that many independent restaurant owners never have access to. Now zoom out even further, because the fast food empire isn't just national anymore, it's global. And the way brands expand across borders reveals another layer of this economic machine entirely. Most major fast food chains don't open foreign locations one restaurant at a time. Instead, they sell what's called a master franchise agreement. A single company or investor group pays a large upfront fee, sometimes tens of millions of dollars, for the exclusive right to develop an entire country or region. That master franchisee then becomes a mini corporation of their own, recruiting local franchisees, enforcing brand standards, and adapting the menu to local tastes, all while still sending a share of revenue back to the original parent company. This is why a McDonald's in India serves no beef products at all, replacing the Big Mac with a chicken or plant-based equivalent, and why a KFC in China offers menu items you'd never find in Kentucky. Local adaptation isn't a suggestion, it's a survival requirement, and the master franchisee is the one responsible for getting that balance right, spending millions on market research most single-location owners will never see. International expansion also comes with currency risk. When a global fast food company reports billions in franchise revenue, much of that money was earned in pesos, yen, rupees, and euros before being converted back into dollars. A strong home currency can quietly shrink reported profits, even when overseas restaurants are technically performing well, which is part of why these companies now hedge currency exposure. The same way an airline hedges fuel costs. There's also a tax layer to this entire structure that rarely gets discussed. Franchise royalties are considered ordinary business income, which means franchisees pay standard income tax on their profits. But they can also deduct many of their operating expenses, from equipment depreciation to marketing fund contributions to interest on their original loan. This is part of why so many financial advisors describe franchise ownership as an unusually tax-efficient way to build wealth compared to simply investing in the stock market, since the owner can actively write off the very costs of running the business. That's building their equity. At the corporate level, the parent company benefits from something even more powerful, because royalty income requires almost no additional capital investment. Once the franchise system is built, it tends to carry extremely high profit margins compared to running company-owned restaurants directly. Every new franchisee who signs on essentially finances their own restaurant, while the parent company simply collects a percentage with minimal ongoing cost. This is why franchising, once a niche business strategy, became the dominant model for nearly every major fast food brand in the world. Of course, not every story ends in success. Some franchise owners expand too aggressively, taking on debt to open additional locations before their first restaurant has even stabilized. Others underestimate how demanding daily operations truly are. From staffing shortages to managing local competition, to navigating slow seasons that can stretch on for months, there have been well-documented cases of franchisees taking legal action against corporations, arguing that mandated fees, forced remodels, and pricing restrictions left them squeezed financially, even while their restaurants appeared successful from the outside. The tension between corporate control and franchisee independence is one of the most persistent conflicts in this entire industry. Franchisee associations have formed in several major chains specifically to negotiate collectively with corporate leadership over fee structures and mandatory spending requirements. Then there are real examples worth examining closely. Chick-fil-A operates one of the most selective and, in some ways, most owner-friendly franchise models in the industry. Unlike many competitors, Chick-fil-A typically requires a franchise fee of only around $10,000, dramatically lower than most major brands. But in exchange, the corporation retains ownership of the real estate and building, and franchisees agree to operate only that one location, no expansion allowed. It's a tightly controlled system, the one that consistently produces some of the highest per-location sales in the entire fast food industry, often outperforming competitors that are open far more hours per week. On the other end of the spectrum, some smaller or lesser-known franchise brands have collapsed entirely, taking franchisee investments down with them when the parent company mismanaged expansion, oversaturated markets with too many locations too close together, or failed to keep the brand relevant against changing consumer tastes. When a corporation sells too many franchise licenses in a single city, existing owners can watch their own sales get cannibalized by a new location, opening just a few blocks away, all while still owing the same royalty percentage on a shrinking customer base. The biggest mistake most new franchise owners make isn't picking the wrong brand. It's underestimating how much of this business is about location, labor management, and operational discipline, not the product itself. Two identical franchises, same brand, same menu, same fees, can produce wildly different profits, purely based on how well one owner manages staffing, waste, and daily execution compared to another. A poorly trained staff member throwing away slightly too much food, or a manager scheduling one extra employee per shift than necessary, can quietly erase thousands of dollars annual profit without anyone noticing, until the year-end numbers arrive. So what does profit potential actually look like in this world? For a single, well-run fast food franchise location, annual profit margins after all expenses often range between 6 and 9% of total sales. On a location generating close to $3 million a year, that can translate to somewhere between $180,000 and $270,000 in profit annually. For a single location owner, that's a solid, professional income. But for a multi-unit operator running dozens of locations, those numbers multiply into a genuine, scalable empire, often generating millions in combined annual profit. That's the real secret behind the fast food franchise fortune. It was never about one restaurant. It was about building a repeatable system, then multiplying it over and over, until volume did what no single location ever could. And once an operator reaches a large enough scale, new advantages appear that a single location owner will never see, from better wholesale pricing on food and packaging, to more leverage when negotiating with the corporation over marketing support and remodel timelines. So is owning a fast food franchise a golden ticket or a financial trap disguised as opportunity? The honest answer is both, depending entirely on execution. It rewards discipline, scale, and operational excellence, and punishes anyone who assumes a famous logo alone guarantees success. In the end, the fast food industry didn't build its empire by selling the best food in the world. It built it by selling a system so reliable that thousands of people were willing to risk everything just